Herzlich willkommen zu unserer heutigen Sendung aus dem Energiestudio in Berlin. Wir werden Ihnen heute den aktuellen Gas Market Report der Internationalen Energieagentur vorstellen. Mein Name ist Charlie Grüneberg, ich leite die Kommunikation hier bei Zukunft Gas. Und den Report werden uns die IEA-Experten Gergely Molnar und sein Kollege Frederik Ritter vorstellen. Wir sind sehr gespannt, denn mit dem Global Gas Security Review 2024 und dem Report zum 4. Quartal wagen unsere Experten einen ersten Ausblick auf den Jahresverlauf 2024 und blicken schon einmal auf den kommenden Winter und die nächste Heizperiode. Wir werden in den kommenden 60 Minuten mehr erfahren über die Entwicklung der internationalen Gasnachfrage und über die steigende Rolle von LNG für die Versorgungssicherheit, aber auch welche Risiken die IEA bei der Gasversorgung im Winter sieht. Die Veranstaltung wird wie gewohnt aufgezeichnet und im Nachgang auf unserem YouTube-Kanal veröffentlicht. Und auch die Präsentation der beiden Referenten sowie den Link zur Aufzeichnung und den Report senden wir Ihnen später zu. Sollten Sie in der Veranstaltung Fragen haben, was wir natürlich sehr begrüßen, dann nutzen Sie gerne die Handhebefunktion oder stellen Sie die Frage im Chat. Now we'll switch to English, and I'm very happy to have you, Gergely, here with us, and also a warm welcome to your colleague, Frederik Ritter. It is always very interesting to hear from you what has happened in the last weeks in the gas market. And of course, we are very interested to see how global gas demand has developed this year and what risk the IEA sees for gas supply next winter. So, Gergely and Frederik, the floor is yours.
Indeed, Charlie, many thanks for your kind words of introduction. It is a great pleasure to be back here at the virtual energy studio of Zukunft Gas. My name is Gergely Molnar. I'm a gas scientist at the International Energy Agency, and for today's presentation, I'm joined by my colleague Frederik Ritter. Together, we will present the key findings of our Global Gas Security Review, a report which have been just published about a week ago. And please allow me to share my screen so that we can dive into our presentation. So the report is, of course, available free of charge on our website, iea.org. And today's presentation will be very much structured along the lines of this report. First, we will have a brief overview of global gas market dynamics. This will be followed by special focus on Asia and LNG markets. Then we will provide an update on LNG contracting trends. And last but not least, we will also provide a focus on the European gas market dynamics. On this slide, we are showing how natural gas prices have been evolving in Northeast Asia and Europe in the first 3 quarters of 2024. The dark blue line shows TTF, a key indicator for European hub prices, and the light blue line is Platts JKM, a key marker for Northeast Asia. And I think it is quite visible here that during the relatively mild Q1, natural gas prices have been going down both in Northeast Asia and in Europe. But we also see that over the second and the third quarter of 2024, gas prices have been strengthening in both importing regions, and actually TTF rose by around 70% since mid-February, and JKM increased during the same period of time by around 60%. We believe that this has been driven partly by tighter market fundamentals, and we will discuss this in greater detail, but we have seen quite a limited increase in LNG supply at a time when demand has been also returning to stronger growth, partly because of seasoning heat waves in Asia. But the second driver behind those higher gas prices have been also the rising geopolitical tensions, which are adding also to price volatility. I also would like to draw your attention to the spread between Northeast Asian prices and and European hub prices, which have been in a way widening through the first 3 quarters. The spread averaged at around $1.6 per MMBTU in the 3rd quarter. And of course, this has been pulling away flexible energy cargoes from Europe towards the more lucrative Asian markets. We also see that the spread between JKM and TTF has collapsed in the last 1 week. And this is partly due to the more sensitivity of the European market to the geopolitical tensions, which are at the moment, unfortunately, unfolding in the Middle East. Looking at the demand side, on this slide, we are showing how natural gas consumption evolved across the key markets we are very closely monitoring, which includes Asia, Eurasia, Europe, Central and South America, as well as North America. And I think what is very clear is that after 2 difficult years, natural gas markets returned to a more structured growth in 2024. Our preliminary data indicates that natural gas consumption increased by around 2.8% across these markets in the first 3 quarters of 2024. And as you can see, most of that growth has been actually concentrated, around half of that growth has been concentrated in Q1. And we also see that there is some slowdown in the actual growth rates in the 2nd and the 3rd quarter. This is partly due to the base period effect, but it is also a reflection of these higher gas prices we have been discussing on the previous slide, which is in a way weighing on the growth in the more price-sensitive markets of Southeast Asia. On this slide, we are showing the regional and the sector breakdown behind the growth we have been seeing in the first 3 quarters of 2024. And I would like to draw your attention that this has been really driven by the fast-growing Asian markets, which alone accounted for approximately 60% of the demand growth in those 5 key markets we are monitoring. In Asia, natural gas consumption increased by an estimated 7% year on year. And this has been very much driven by China and India, both of which returned to double-digit growth rates this year. We have also seen some strong growth in Eurasia. This is very much driven by Russia. In North America, growth has been rather moderate at around 1%, and this has been clearly driven by the higher gas to power demand, so by gas-fired generation. In contrast with other regions, in Europe, we continue to see a decline of around 3%, mainly because of the lower gas burn in the power sector. And in Central and South America, we have seen only limited growth, partly due to higher gas consumption in the residential and commercial sectors, and also some incremental gas demand from the power sector due to lower hydro availability in Colombia and in Brazil. But when we are looking at this picture, I think it is also important to note that gas use in industry was a key driver. It accounted for approximately 60% of the demand growth. And this has been partly due to fast-growing Asian markets, but also some recovery we started to see in Europe on the back of the lower gas prices compared to the 2022 price environment. On this slide, we are presenting our short-term outlook for natural gas demand until 2025. And it shows that global natural gas demand is expected to increase at an average rate of 2.4% between 2022 and 25, and as such to reach an all-time high of almost 4.3 trillion cubic meters. In terms of regions, this growth is very much driven by the Asian markets, which alone are expected to account for almost half of the demand growth. On this slide, we are sort of giving a closer look to this demand outlook. So in absolute terms, we expect that global gas demand will increase by around 200 BCM from 2023 to 2025. And when we are looking at this picture from a sector point of view, it is very clear that the most important driver behind this increase will be industry and energy own use, which together would account for almost half of incremental gas demand during this period. And most of that growth is expected to be concentrated in the Asian markets, which are expected to grow at a rate of around 5%. Again, very much on the back of China and India. And this is a topic which will be covered in great detail by Frederick. And here again, we see that in the Asian markets, the growth will be primarily driven by industry. As well, we also see some potential for natural gas growth in the power sector. A second important driver behind gas demand will be the gas-rich markets of the Middle East and Eurasia and Africa. And those markets are forecasted to grow at around 3% during the 24-25 period. And here again, we see quite some demand coming from the industrial sectors, but also in the Middle East and Eurasia from the power sector. In the Middle East, this is primarily driven by the oil to gas switching and dynamics in Saudi Arabia, as well as Iran. When we are looking at Europe, we see limited growth potential here. We expect some recovery happening in the residential and commercial sectors on the back of the assumption that we will return to more average weather conditions, as well as we also expect some recovery happening in industrial gas demand, most of which is actually concentrated this year. But all these gains are almost entirely offset by the continued reduction in gas use in the power sector due to the rapid expansion of renewables. On this slide, we are moving more towards the supply picture, and it shows us the key channels of global gas trade, which includes pipeline imports into Europe, pipeline imports into China, as well as global LNG supply. And I think what is important to note here is that after the 2 years of the gas supply shock, when we have seen a steep reduction in Russian pipe gas deliveries to Europe in 2024 and 25, the global gas trade has been returning to a more balanced picture. In 2024, we have seen an increase in LNG supply, although it has been rather limited at just around 2% growth. And we also expect that LNG supply increase will accelerate in 2025 and to grow at around 6%. Again, this is a topic which will be covered in depth by Frederick. But I also would like to draw your attention that despite this increase in LNG supply, and also we have seen some growth in piped gas supplies, both to Europe and to China, actually from Russia. So there is this growth, but it is not sufficient to offset the declines we have seen from Russia. From Russia, we lost about 120 BCM in 2022 and 23, and we also expect, or we assume, that the Russian pipe gas transit via Ukraine will cease after January 25, which will add a loss of 15 BCM. So almost 140 BCM of Russian pipe gas is expected to be lost between 22 and 25. And we also see that the additional LNG supply and pipe gas supplies are not enough to offset those losses. This means that we need more LNG supply growth in order to be back to the pre-crisis levels in terms of gas supply availability for the global traded market. And with that, I would like to give the floor to my colleague Frederick, who will give us a close overview of the Asian markets as well as LNG supply-demand dynamics.
Great. Thanks very much, Gergely, for these initial remarks on global gas trends over the past couple of months, first 3 quarters of this year, and also for these overarching messages on what we expect in our outlook in the rest of 24 and the rest of 2025. So as Gergely mentioned, I'm going to focus here a little bit on Asia and LNG, which are 2 crucial angles in understanding our forecast out to 2025 and how we see the global gas market essentially teeing up for the later part of the decade beyond our current forecast that we're presenting in this latest gas market report. Now, Asia Pacific is the largest contributor to this 3%, approximately 3% global gas demand growth that Gergely mentioned in 2024, and the 2% growth that we expect in 2025. So if we look at the chart on the left, what we're doing here is breaking down incremental demand in the region by pulling out China, India, mature APAC markets, and then other Asia Pacific markets as another block. So as a region, what we see is that APAC is set for about 5% growth in both 2024 and 2025. These are the rates that we have in black at the top of the blue columns, compared to the global growth rates in gray that are just within the blue columns. So we've got an easy comparison of these not diverging dynamics, but dynamics at different speeds between Asia and the rest of the world. As you can see, APAC growth outstrips global gas demand growth in the forecast. We expect the region to account for about 50% of incremental volumes out to 2025. And China is, of course, this first factor here, and we'll take some time to dive into this in the next couple of slides. But first, I do want to highlight on this slide the role of mature Asian markets here. It's a somewhat of a sliver, a slight element in incremental growth. But it is important just to spend a couple minutes on this. Here, what we're talking about is notably Japan and Korea, which are on a long-term declining path, but are likely to hold back this year, particularly due to strong weather effects on the power sector. So what we're talking about here is cold weather in winter, and then heat waves that hit Japan and Korea and the rest of Asia, as Gergely mentioned a little bit earlier, which are leading to somewhat of a flat but positive dynamics in 2024 for overall demand in this market segment, essentially as power sector gains balance out industrial weakness in these markets. As we move into 2025, however, we see how this longer-term decline picks up again as nuclear availability improves in both of these specific markets that I mentioned, and as renewables continue to be rolled out. So essentially, we're talking about a power sector crunch on natural gas. That is what's behind this dynamic in mature APAC markets. Now, on the right-hand chart, we've got a sectoral split of this incremental demand in the region, and we see right away that 2024 trends are expected to flow into 2025 as well, with industrial activity remaining a central element to overall gas demand growth in the region. Nevertheless, APAC as a region is comprised of, number one, many markets, and number two, disparate markets. So with very different economic structures, different overall economic or energy supply mixes as well. So while industry is a central driver in markets like China and India, for example, the power sector has a larger growth role in other emerging APAC markets. And we'll have a look at this in a couple of slides. Now, let's turn back to the first factor I mentioned on this slide here, but that I skipped over previously. This is China. Now, it's not that we want to reduce Asia to China, but we cannot talk about Asia without focusing a little bit on China. It's simply the key driver of global gas demand growth and global LNG demand growth as well. In the previous slide, I mentioned that APAC as a region is set to account for nearly 50% of global gas demand growth out to 2025, and China is set to account for nearly 70% of this chunk of incremental APAC demand. Before we go into the forecast, though, I do want to spend a couple minutes on this slide looking at what's been happening this year within the context within a sort of short-term historical context, if you will. We're showing here year-on-year changes in quarterly gas demand by sector for China, going back to 2022 and the peak of the global gas supply crunch. So we see how Chinese demand took a hit in that period. Let's not forget that some of these COVID-related restrictions were still in place at that time throughout 2022. 2023 brought about a significant recovery effect with economic activity kicking back in and a great deal of demand essentially catching up from a 1% decline in 2022 to a 7% increase in 2023. But what about 2024 so far? We estimate, and this is something that Gergely brought up at a global level, but this is also true at the specifically the APAC level. We estimate that the recovery effect has largely been used up in 2023, and now we're moving on into a phase where fundamental growth is going to have to carry the market forward. Weather has also played a role here in 2024 so far, with cold weather in Q1, heat waves in spring and later on through summer, which helped boost both residential and commercial demand, but also power sector gas burn as cooling needs have increased over the summer period. Industry has remained strong, of course. This is where, on the other hand, this is also where Chinese economic activity is going to be a very important underlying factor. Will manufacturing keep up? Will construction activity recover? So let's have a look a little bit at what this looks like in our outlook for 2024 and 2025 on the next slide. So we forecast gas demand to grow by around 8% in 2024 and 2025, just ever so slightly, a slight decline in 25, adding about 65 BCM of demand compared to 2023 levels, so from 23 to 25. Industry is, of course, the biggest chunk, but gas is also growing in the power sector. Distribution level connections are growing, and the use of gas and LNG in transport is on an upward path as well. Of course, the risk that I highlighted just moments ago, that economic risk, remains, but we do see gas demand as relatively robust over this short-term outlook period. The sheer size of the Chinese market means that any movement will create waves in the global supply picture. So still looking at the chart on the left, let's turn to the column that's just on the right. Domestic natural gas production has been growing steadily these past years in China, and China continues to tap into both conventional and non-conventional resources. Just as a bit of somewhat of a parenthesis, it's often forgotten that about 60% of Chinese demand is covered by domestic production. So it is a market that has important gas reserves. We also see that pipeline imports from Russia through Power of Siberia are set to reach their nameplate capacity levels in 2025 at around 38 BCM. So globally, as I mentioned, China has considerable resources. It's well connected by pipelines to important suppliers. But importantly, LNG continues to be a big element of incremental supply for the market. So on the chart on the right, we're looking at annual LNG imports in a few of the largest importing markets. What we see is that China has surpassed Japan as the world's largest importer, accounting for about 20% of the global market in 2024 and 2025, and having mostly recovered from the drastic reduction in imports in 2022. And in fact, we expect Chinese LNG imports to slightly surpass their previous 2021 peak this year. Now, in the next slide, I want to have a look at India and other emerging APAC markets. So let's just take note of what we saw in the previous slide was that we see growing LNG imports for both of these regional segments as well, other APAC and India. And this is something we'll see on this current slide. So yes, China is the first factor, but it's not the only factor in Asia Pacific. And that's what we'll spend a little moment on here. The issue is that the rest of Asia Pacific is a much more dispersed story, but we can look at it essentially with India on the one side and the rest of emerging Asia as a single block on the other. We forecast Indian gas demand to grow at around 8.5% compound annualized growth rate, so CAGR from 2023 to 2025. And this is set to be driven by the industrial sector, notably by increased demand through domestic production of fertilizers, for example. While the power sector gas burn continues to grow, gas does remain relatively expensive for the power mix and is therefore very much a secondary story in growth for India. Other emerging Asia, however, is set to see power sector gas demand grow significantly. So these are markets where, in some cases, LNG to power has been touted as a way of switching away from coal, for example, or at least eating into a share of the thermal mix and softening coal demand in the future. Now, on the previous slide, if we think back, we also saw how LNG imports in these markets are very much on the rise. And on the chart on the right, we see another angle to this. What we're showing here is LNG imports as a share of total gas demand or total gas supply in each of these market segments in the APAC region. The red and purple lines give us the key takeaways for this slide. So namely that incremental gas demand in India and other emerging APAC translates into an increasingly large call on the LNG markets. This LNG share of supply has fluctuated in recent years for India. That's true, but it has been on the rise more recently. And while the share is somewhat lower in other emerging Asia, it does remain on a constant rise, or it has remained on a constant rise these past years. So while we expect 8.5% CAGR in Indian demand growth, LNG imports will be up by 15% over the same period. With 4% CAGR in gas demand in growth in other emerging Asia, we see 10% CAGR in LNG import growth from 2023 to 2025. So these are growth markets, in some cases with mature resource basins that are mature and not at end of life, but on the decline, and with limited pipeline import options, essentially leaving LNG as an important lifeline in firming up the gas mix and the broader energy supply mix. So given the importance of LNG in backing this demand growth in the APAC region, what can be said of the state of the LNG balance in 2024 and 2025? So on the demand side, let's see how what we've just covered feeds into the global picture. Asian LNG imports are set to grow by around 8% in 2024, up from 4% last year, as prices were considerably down, particularly in H1, at least down to more palatable levels, we'll say, allowing some buyers to return to the spot markets. We also see significant new contracted volumes here as a result of new contract signatures over the past years. So we're not just talking about spot growth in the APAC markets. The counterpart to this story in 2024 is European LNG imports have continued to drop as demand has continued to decline. So not just from a demand destruction point, but also from the durable impact of renewable power generation. This is something that Gergely has touched on and we'll touch on a little bit later as well. But 2024 represents a clear acceleration of what had started out in 2023 for both of these regions. I won't do a deep dive into this other category here, but I will highlight just a couple of elements. The first is drought conditions in South America driving up LNG imports in markets like Brazil and Colombia. And the other is drastic turnaround, a really drastic turnaround in the situation for Egypt, worsening upstream conditions, growing domestic gas demand. Essentially, the country has turned from an LNG exporter again to an LNG importer. So this is a little bit of what we see behind this other segment. Now, in 2025, one key element of the LNG demand story changes, with demand destruction in Europe likely bottoming out, and under the assumption that the Ukraine transit agreement for Russian pipeline gas is not renewed, as Gergely mentioned, Europe is set to be back for more LNG in 2025. So no longer will the Atlantic and Pacific import basins be moving in opposite directions as they did in 2023. In 2024, but rather they'll be moving in the same direction, and this is going to require an acceleration of supply growth. So we do see a slight deceleration of Asian LNG imports in this period that's somewhat linked to mature Asian markets easing their pull. But what do we see on the liquefaction front, and do we have enough LNG coming to the markets to answer this demand call? That's the big question. So we're expecting a new wave of liquefaction capacity to come online in the second half of this decade, although the term second half of the decade is a rather large period. And this was slated to start progressively in 2025. But what we see is that a few elements have coincided to slow this start. And this is the key element in the diagnosis that we have, the broader diagnosis that we have of the global gas demand market, that it's not quite out of the woods yet. The balance remains somewhat fragile in 2025. Now, 1 year ago, we were forecasting a 13% increase in LNG supply between 2023 and 2025. That's what we see in the part on the left of the chart, mostly on the back of US projects ramping up, of course. But over this past year, what we've seen is a series of project delays. Number one, sanctions on projects, number two, and number three, underperformance at legacy projects, which have led us to essentially scale back this increase to about 8% from 2023 to 2025. Just a few details to highlight what we're talking about here. In the US, for example, the Golden Pass LNG project is now likely to be pushed back out to 2026 after bankruptcy of its lead contractor. Projects that are starting up, like the Corpus Christi expansion in the US, are also likely to be very much progressive in 2025, with substantial volumes materializing only in 2026 and 27. Mexico's project Energía Costa Azul is set to be delayed also into 2026. Looks like early volumes from Qatar's North Field East expansion. We weren't necessarily expecting them to be online in 2025, but they're certainly being pushed back out to 2026. And then, of course, the big element here is Russia. So international sanctions on Arctic LNG 2 Train 1 mean that a project that came online in late 2023 is still not exporting volumes. So apart, of course, from a few cargoes aboard shadow vessels that have yet to deliver their shipments. So it was always anticipated that 2026 and 27 would bring about the majority of this next wave of LNG supply. But the start in 2025 is looking like it's going to be even slower than previously expected. And for this reason, 2025 is increasingly looking like another transition year towards this well-supplied market in the later part of the decade, and towards a scenario of easing fundamentals. So when we match this up against LNG import requirements across both Asia and Europe, we come to the conclusion that the balance remains fragile, that we should remain ready to see continued volatility as the market comes to terms with this potential frictions that come out over the coming months. I think Gergely alluded to these, of course, seasonal demand ramping up, Russian pipeline volumes to Europe with that uncertainty, underperformance, again, potential underperformance at legacy projects, and of course, that element of geopolitical tremors. So let's recall that prices are indeed much lower today than they were, for example, a year or two ago, but they remain high and volatile compared to where they were before the global gas supply crunch. So this is the context with which we're working moving into 2025. And on this note, I'll hand it back to Gergely for a few more comments on LNG contracting trends.
Thank you very much, Frederick, for this excellent overview of the LNG markets as well as Asia. And as mentioned by Frederick, now we are moving to LNG contracting. But before that, maybe just say a couple of words also on final investment decisions and LNG project developments. Since 2022, around 150 BCM per year LNG liquefaction capacity has been sanctioned or approved. If you are looking at 2022 and 23, this picture has been very much dominated by the United States, which alone accounted for around over 70% of all the FIDs taken during that period. And we see that that the interest behind LNG project development remained quite strong in the first 3 quarters of 2024, with just over 45 BCM per year LNG liquefaction capacity approved, including Qatar's North Field West expansion project. But we also see that that since January 2024, no FID have been taken in the United States since the temporary pause on pending decision on exports of LNG to non-FTA countries. And we also see that 2024, in terms of announced LNG project developments, is very much dominated by the Middle East, alone accounting for almost 80% of the capacity which has been sanctioned. This is driven by Qatar, the United Arab Emirates, as well as Oman. And besides that, we have seen also FIDs taken in Mexico and in Canada, as well as in Congo. But we also see that shift towards the Middle East in terms of energy project developments after 2 years, which have been very much dominated by the United States. If we are looking at LNG contracting trends, on this slide we are showing how this evolved in terms of export and import contracts. And here again, I think it is important to highlight that there have been a shift from a landscape which has been very much dominated by North America in 21 and 22 to a dominance by the Middle East, which accounted for about 55% of all the LNG export contracts concluded since the start of 2023. And here again, the dominant player is of course Qatar. When we are looking at this picture from an importing side, we see that in 2023 there have been quite some interest from the European market players in the LNG contracting space, which have increased their share. But we also see that in the first 8 months of 2024, the share of European market players have declined to just around 10% in the total volumes contracted. And we see that the importing landscape is very much dominated by Asia. Asian buyers accounted for over 50% of the total volumes contracted since the start of 2023. When we are looking at the different flexibility metrics which we track in the Global Gas Security Review, we see that in 2023 and 2024, there had been, in a way, a return to more traditional contractual terms. On the first graph of this slide, we are showing that the contracting landscape is very much dominated by long-term contracts with a duration of at least 10 years, and they accounted for over 85% of the volumes contracted since 2023. And again, this is a reflection of the preference to conclude long-term contracts by Asian players, which accounted for almost half of the long-term contracts signed during that period. And also, I think it is a reminder for market players that long-term contracts can ensure a more stable supply outlook and a less volatile import price pattern. On the second slide, we are showing the evolution of destination flexibility in the agreements which have been concluded. And I think here what is important to note is that in both 2023 and 24, destination fixed contracts have been quite dominant, accounting for around 70% of the volumes contracted. And this, in a way, also reflects some cautiousness on the buyers' side and their willingness to secure more stable supplies at a times of heightened price volatility. And on the third graph, we are showing how LNG contracting evolved in terms of the size of the contracts. I would like to draw your attention that in 2023, large contracts with a volume of over 4 BCM accounted for 57% of the volumes contracted. This is the highest share of large contracts since 2017. Again, this might be a reflection of market players being more concerned or valuing more supply security than in previous years. And also it is reflective of the preference of certain sellers to have larger LNG contracts. Now, despite this return to more traditional contracting features, the global LNG market is expected to gain in terms of depth and liquidity over the medium term due to the gradual expiry of legacy contracts. On the first row of this slide, we are showing that the share of destination flexible LNG contracts has been increasing quite significantly since 2016, from around 30% to 47% by 2023. And we expect that their share will increase to over 50% by 2027. The role of portfolio players is also increasing. It rose from around 26% of all the contracted volumes in 2016 to just over 40% in 2023. And again, based on our internal contract database, we expect that the share of portfolio players in the total contracted volumes will increase to around 44% by 2027. And in the last row, we are showing how pricing terms are becoming more diverse. Of course, LNG contracting has been very much dominated by oil indexation in the past. And in 2016, the share of oil index contracts was around 70%. This share declined to 56% by 2023 and is expected to fall further to 52% by 2027 at the expense of gas-to-gas indexed contracts, as well as hybrid pricing formulas. Now I would like to move to Europe. On this slide, we are showing how European natural gas consumption evolved in the first 3 quarters of 2024. And our data indicates that natural gas demand declined by around 3% or 9 BCM during that period. This has been partly due to lower gas demand in the residential and commercial sectors on the back of milder weather conditions and also some gas saving measures. But as you can see on this slide, the key driver behind that lower gas consumption was the power sector, in which we have seen a drop of over 16% due to rapidly expanding renewables as well as improving nuclear availability. And in contrast, we have seen some recovery happening in the industrial sectors, but still here, natural gas use remains well below the pre-crisis levels. On this slide, we are showing a closer look on the European power sector, which is undergoing a profound transformation. In the first 3 quarters of 2024, renewables increased by around 16%, and around 40% of this growth has been actually improving hydro availability, mainly in the South European markets. But we also see a continued strong increase in wind and solar, which together increase their output by around 15%. This strong growth in renewables, as well as the improving nuclear availability, has been naturally weighing on thermal power generation, both gas and coal-based generation. But we also see that gas-fired power output has been most affected. And as we mentioned on the previous slide, it has declined by around 16% in the first 3 quarters of 2024. This relatively weak demand fundamentals, together with the high storage levels inherited from the 23-24 winter season, has been also weighing on Europe's LNG import requirements, which dropped by around 20% in the first 3 quarters of the year. But we also see that part of that picture is that the piped gas deliveries from Norway has been also putting downward pressure on LNG import requirements. In Norway this year, we had less maintenance that compared to 2023, which allowed for an increase of piped gas supplies from Norway. And also I would like to draw your attention to this higher piped gas deliveries from Russia, both to the European Union and to Turkey. Maybe also give some positive news, as we are all aware of. European storage sites are quite filled, standing at the moment at around 95% of their working storage capacity, which is well above the 5-year average, and should give us cautious optimism ahead of the 24-25 heating season. But of course, there is a number of uncertainties ahead of the upcoming winter season. And here we just wanted to picture that while there is a lot of discussion on the supply side, and namely on the uncertainties stemming from the Russian gas transit by Ukraine, the largest uncertainties are actually linked to the demand side. The temperature variations can, of course, significantly impact the demand in the residential and commercial sectors in the European Union. And depending on the weather patterns, the uncertainty range could be around 25 BCM. There's also an uncertainty related to China's LNG appetite, which in our view could vary again in a range of an uncertainty range of around 20 BCM, depending on weather patterns, macroeconomic gas, and also availability of piped gas supplies from Central Asia. So when we are looking at Russian gas transit via Ukraine, this gives us an uncertainty range of around 7 BCM. And as mentioned earlier in this presentation, our assumption is that Russian pipe gas transit via Ukraine will not continue after January 25. And this will, of course, have mainly implications on a number of Central and Eastern European countries. And our analysis shows that this should not lead to imminent supply disruptions, but of course would lead to a tighter European and global gas balance. I also would like to spend 1 minute on the Middle East. As the tragic events unfold in the Middle East, it is important to remind the crucial role the Middle East plays in global and regional natural gas supply security. And here we will keep it just to the facts. The Strait of Hormuz accounts for just over 20% of global LNG trade. The share of Israel piped gas in Egypt primary gas supply has been increasing in recent years. As mentioned by Frederick, Egypt is facing a steep decline in its domestic gas production, and as such, the share of Israeli piped gas increased to around 15% in the country's primary gas supply in the first 7 months of 2024. And of course, Iran's piped gas supplies also play a very important role in meeting natural gas demand in Iraq, as well as in Turkey, where it accounted for, again, around 15% of the country's primary gas supply in the first 8 months of 2024. So at the International Energy Agency, we are closely monitoring the situation. I'm very conscious that we have only 8 minutes left from today's discussion. So maybe we could open, Charlie, if you agree, the Q&A session.
Yes, wonderful. This is a good idea. I already received a few questions. Thanks a lot, Gergely and Frederick. How's your assessment on the development of gas-fired power generation in Europe in 2025? Do you think the decline might continue, or do you expect a stabilization or even a turnaround? And maybe I may add another question to it. What is your explanation for the strong increase of gas to power in North America compared to Europe?
Thank you, Charlie, and thank you for this important question, Anne. When we are looking at 2025 in Europe, we expect that renewables will continue to expand, and of course this will weigh on gas-fired power generation. Of course, hydro is always, in a way, an uncertainty. As mentioned, this year, around 40% of the growth in renewables has been hydro, but we should not forget that 2023 has been quite a dry year. So this year, we are, in a way, just returning to more normal hydro availability. So there is we are working on the assumption that next year will be also an average hydro year, and we continue to see a strong expansion in wind and solar. And with that, I think it is also important to note that maybe there is less gas used in the power sector, but the backup role of natural gas-fired generation is increasing as we are gradually phasing out coal and lignite-based generation. I think on the 1st of October, the last coal-fired power plants closed in the United Kingdom, and of course the backup role in that market for CCGTs, gas-fired CCGTs, is going to increase. On the question related to North America, the answer is mainly due to the very low gas prices we see in the United States. Henry Hub prices averaged just above $2 per MMBTU in the first 3 quarters of 2024. And of course, this puts natural gas-based generation at a very competitive play against coal-fired generation. And we also had some heat waves in North America during the summer, including in July, when gas-fired power generation increased to an all-time high. So I think this is a combination of weather and also the price competitiveness of gas-based generation.
In recent weeks, there have been some setbacks in Europe in some hydrogen projects. The Norwegian company Equinor has put its plans for hydrogen pipeline to Germany on hold for the time being, and Denmark is also postponing the planned construction of a hydrogen pipeline to Germany. How does the IEA currently assess the role and potential of hydrogen?
That's indeed something we see, that there is some backtracking in terms of hydrogen projects. And I think that this is in a way reflective of the demand uncertainty for low emissions hydrogen. And this is very much in line with the key messages we have been putting out in various publications, including in the Global Hydrogen Review, which has been published last week and also available on our website, that policymakers should very much focus on the demand side and to give more clarity on low emissions hydrogen demand. So demand creation is key in order to enable long-term offtake contracts, which in turn are key to take FIDs. I think this is one. The second point is that we need a more holistic approach to subsidy schemes and support mechanisms, which are targeting the entire value chain and not only some part of it. And the third one is we also would like to reiterate the importance of regional cooperation, building on the national synergies, which could facilitate the development of low emissions hydrogen projects. About a few weeks ago, I said that in terms of hydrogen, we moved from hype to hope. But I mean, we still see hydrogen as an important component of the decarbonization agenda, including for the hard-to-abate sectors. But there is certainly a need to strengthen policies in that respect, because I think we are entering a critical phase if we want to meet at least some of the targets which have been set to 2030.
Okay. And one last question that is very much discussed in Germany. We had a very high tense discussion about LNG terminals in Germany. And you mentioned the high dynamic of the LNG market, the global LNG market. From the point of view of the IEA regarding Europe and Germany, because we have here the questions, if we have too many LNG terminals in Germany, what is your point of view according to that?
So I think this is always a question to project developers and whether they are able to secure long-term capacity contracts and then to make a final investment decision based on that. It is, I think, important consideration for project developers that in Europe we are in a phase of energy transition, and as such, when projects which are developed to enable a greater uptake or more flexible uptake of fossil fuel, they need to be either flexible in a way that these infrastructure components can be brought to other markets, which is the case of FSRUs, or they should be flexible in a way that they could be repurposed to enable the uptake of low emissions fuels such as liquefied e-methane or liquefied biomethane, bio-LNG, course, there are question marks on the feasibility for repurposing LNG infrastructure to low emissions hydrogen. But this should be also closely investigated.
Thank you very much, and thank you, Frederick and Gergely, for these interesting insights again in the international gas market. It is always very interesting, and we are looking forward to the next report in 3 months. And thank you that you stayed with us some minutes longer than estimated, but I think it was worth the time. Wir sehen sehr viel Dynamik im Markt, vor allem im LNG-Markt sehen wir sehr viel Dynamik und stehen auch diesen Winter wieder vor spannenden Zeiten, auch wenn zumindest mit Blick auf die Speicher Westeuropa ganz gut vorbereitet scheint. Ich danke auch Ihnen, liebe Zuschauerinnen und Zuschauer, vielen Dank für Ihr Interesse und Ihre Fragen. Die Präsentation, den Report werden wir Ihnen im Nachgang zu dieser Veranstaltung zusenden und zeitnah finden Sie auch, dann senden wir Ihnen auch einen Link zur YouTube-Aufzeichnung der Veranstaltung zu. Ich wünsche Ihnen noch einen erfolgreichen Tag, bleiben Sie gesund und vielen Dank.